Welcome back to Investing Talk Podcast.
Today, we're looking at SKYT technology.
Okay.
You sent us a fascinating stack of sources detailing, well, a massive operational turnaround. And we're going to break down exactly why this U.S. specialty chip manufacturer is suddenly on everyone's radar.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of this specialty U.S. chip manufacturer, because the narrative here shifted dramatically. Really, it was in November following their Q3 2025 earnings report.
Yeah.
For anyone who hasn't been following closely, this was kind of a moment of absolute validation.
Validation might be, well, an understatement. When we look at the Q3 2025 results announced back in November, they didn't just meet expectations. They blew them out of the water. I mean, Wall Street was expecting a loss. The consensus forecast was predicting, what, like negative $0.17 per share?
A loss.
Yeah.
But the company delivered a profit, around 24 cents per share.
Wow.
That's a 41-cent positive swing per share.
Oh.
Now, for a company that has been, struggling with bottom line profitability, this isn't just good news. It feels like a structural pivot.
And the top line confirmed that momentum, didn't it? Revenue came in at $150.74 million. Comfortably beating the $135.5 million expected.
Yeah, and management was quick to point out this was a record quarterly revenue performance for SKYT. A record.
What's crucial for you, the listener, to understand is the implication of that record quarter, especially when you look at their historical performance. We see this dramatic narrowing of the trailing 12-month net loss.
That's where the story of the turnaround really takes shape, I think. Previously, the trailing 12-month loss was pretty painful, negative $77.91 million.
Yeah, steep.
Now, sitting at negative $16.49 million.
Big difference.
Huge. When management can execute a shift of that magnitude in cash burn, it proves, well, a couple things. One, the cost control measures they implemented are working.
Right.
And two, that demand for their specialized services is really soaring.
Exactly. It shows that the business model, which is, let's face it, highly complex, very capital intensive, it's finally achieving the scale needed to approach self-sufficiency. This isn't just about winning one big contract. It points to improving operational efficiency across the board.
Yeah, I agree. So the next logical question then is, what specific parts of the operation drove this massive beat? Where's it coming from?
I see two clear operational drivers discussed in the sources we looked at, and they both revolve around expansion and cutting-edge technology. Let's start with the geographic story. Texas.
Ah, yes, the Texas expansion. It's been swift and apparently quite successful. SKYT finalized the acquisition of the facility they call Fab 25 down in Texas, which immediately provided much-needed capacity. This effectively creates two distinct manufacturing segments. You've got legacy SKYT and now SKYT Texas.
And what's truly impressive is the speed, isn't it?
It is. The Texas site is already generating revenue and profitability above the initial internal forecasts. So that facility is proving to be a highly effective growth engine, like right out of the gate.
That rapid integration, well, it validates management's M&A strategy there. But the other driver is the technology that seems to excite the market the most. Quantum computing.
Yes. The Advanced Technology Services, the ATS, revenues linked to quantum have surged. We saw them announce, 4 new quantum customers just recently?
Right, 4.
And they are projecting over 30% annual growth specifically in that quantum-related business for the current fiscal year.
30%, that's significant.
It is, especially because this is a segment that carries high margins and high strategic importance.
And it's not just small players either, right? The quality of their collaborations is key here. The sources highlight that multi-million-dollar collaboration with QuamCore.
QuamCore.
Specifically focused on superconducting quantum processor architecture. Now, for the listener who might not be familiar with this area, what exactly is superconducting quantum processor architecture, and how does that create a moat for SKYT?
Right. So it's highly specialized foundational work. Think of superconducting processors and related SFQ devices. That's single flux quantum. These are the building blocks for creating practical, high-speed quantum computers.
Okay.
Very few fabs globally have the specific expertise, the tooling, the know-how to handle this level of complexity, the low temperatures, the precision required.
I see.
SKYT's involvement here cements them as a cornerstone player, really, in trusted U.S.-based manufacturing for the next generation of computing. It's essentially future-proofing their most advanced capacity.
And speaking of future-proofing, here's where the future catalysts become really tangible: advanced packaging.
Ah, yes.
This is an absolutely essential and often overlooked step in modern semiconductor manufacturing. It helps stack different functional chips together efficiently.
And we know that advanced packaging operations down in Florida are ramping up. Tool installations are happening now.
Okay.
Crucially, the target timeline for prototype customer builds in that packaging segment is early 2026.
Early 2026, so not immediate, but on the horizon.
Right. This is the new frontier for efficiency in chips, and if SKYT can execute on that timeline, it represents a significant long-term revenue stream coming online. It also diversifies them away from just, raw wafer manufacturing.
Okay, shifting gears a bit to the financials underpinning all this growth. The momentum from Q3 seems reflected in the broader outlook, too. FY 2024 revenue reached $342.27 million, which was an impressive 19.39% increase year over year.
And analysts expect that pace to hold pretty steady. The consensus projection for 2025 annual revenue is around $348 million, which implies continued robust growth near 20%. And that profitability we talked about, the Q3 surprise, it looks sustainable, at least in the short term.
How so?
Well, the Q3 gross margin hit 24.0%. That translated to $36.2 million in gross profit. Now, for a specialty foundry focused on highly customized, often lower volume runs, that margin is a strong indicator.
Strong indicator of what? Pricing power.
Pricing power, yeah. And lean operation. It shows they're managing costs effectively, even with complex processes.
And beyond the numbers, the structural advantage, their moat, seems truly exceptional here. They are a pure-play technology foundry focused entirely on domestic U.S. manufacturing.
That's huge right now.
In a world increasingly concerned about supply chain resilience, that geographical location is perhaps their greatest asset.
I agree. Their trusted foundry status provides a huge geopolitical advantage. This status is vital for attracting, lucrative, secure, high-margin contracts from the U.S. Department of Defense, other government entities.
The ones that can't risk using offshore manufacturers.
Exactly. And that is complemented by their highly sticky co-creation model.
Right. Tell us more about that co-creation model. How does it practically enforce customer lock-in? Because that sounds powerful.
It really is. When a customer partners with SKYT, they don't just hand over a design blueprint. They partner on the R&D itself to optimize the manufacturing process for that specific chip. Whether it's for, say, rad-hard chips for space, that means radiation hardened, or specialized MEMS devices, or custom analog mixed signal chips. Because SKYT develops the specialized process IP alongside the customer. That customer can't easily just take the process and move it to a competitor fab without basically starting from scratch. It binds them together for years.
That level of lock-in is a powerful counter to the inherent risks in specialty manufacturing. But let's, address those risks head on. Given this rapid growth and the high expectations now baked into the stock price, what happens if execution hits a snag?
That's the critical balance we must strike, absolutely. While the net loss has dramatically narrowed, it does still persist for the trailing 12 months.
Still red on a TTM basis.
Right. They haven't achieved sustained GAAP profitability yet. Furthermore, because their strategy hinges on winning these large, specialized contracts, like that Quancore deal, there is an inherent risk of high customer concentration. If a key partnership were to abruptly end, or if a major contract churned unexpectedly, it could destabilize results very rapidly.
And that potential instability, it's reflected in the technical picture too, isn't it? We saw earlier that the beta is extremely high.
It is. The beta is 3.51. For anyone unfamiliar with the term, think of beta as how volatile a stock is compared to the overall market, like the S&P 500. If the S&P 500 moves 1%, this stock is expected, statistically, to move 3.5% in the same direction.
Wow. So big swings.
Big swings.
Yeah.
The contract churn risk, combined with high customer concentration, means that when good news hits, the stock rockets, sure. But if there's any perceived failure in execution, it can crater just as fast.
That's a fair point on the execution risk and the volatility. Okay, now let's look at the sophisticated money, the institutions. They are often seen as the ultimate indicator of conviction, right? And their activity paints a compelling picture here.
It does. Institutional ownership grew by a solid 10.25% in the last quarter. Funds now hold 19.6 million shares.
Okay, decent growth.
But even more telling, I think, is that the average fund weight grew by over 26.57%.
What does that mean exactly?
It means the professional money managers who already owned a piece of SKYT decided to substantially increase their allocation. They didn't just dip a toe in, they committed more capital.
Right.
We even have specific examples, like Peak and Hardy Strauss adding 28,000 shares. That's institutional validation of this turnaround story.
Right. But we cannot just gloss over the major conflicting signal that popped up in the sources,
Right.
the insider selling.
Ah, yes. That needs discussion.
Insider transactions in October 2025 totaled a combined $41.17 million. That's a significant amount of capital flowing out from people who should know the company best. How do we reconcile that with the surging institutional confidence?
It's absolutely a signal that demands scrutiny. You're right. Selling by insiders always raises a red flag because they have intimate knowledge of operational challenges, maybe future funding needs, things like that. However, the context here is that insiders still collectively hold a huge chunk, 37.85% ownership.
Okay, so they still have a lot of skin in the game.
A lot. While $41 million is a big number, if the selling is related to diversification, maybe tax planning, or exercising expiring options, rather than systemic operational issues, it might not be catastrophic. But the prudent investor must see it as a check on exuberance. It demands continued operational proof.
Fair enough. The street consensus, though, despite that insider selling, is unequivocally bullish. Analyst consensus is currently a strong buy.
And those price targets signal, I think, long-term strategic belief. Piper Sandler lifted its price target to $17, reflecting the immediate operational improvements.
Okay.
More dramatically, Stifel Nicolaus initiated coverage with a high target of $25.
$25?
Yeah. That kind of high watermark suggests that Stifel sees the company fully capitalizing on the quantum opportunities the government contracting over the next few years.
And from a purely technical standpoint, putting fundamentals aside for a moment, the momentum is undeniable, provided you can stomach the volatility we mentioned earlier.
Right. The stock is trading strongly above both its 50-day simple moving average, which is currently around $15.45, and its 200-day SMA, way down at $10.70.
So a clear uptrend.
Yes. This pattern, the short-term average being well above the long-term average, confirms a strong bullish trend that really began in earnest following that Q3 earnings beat.
So if Q3 was the launch pad, we need to look ahead. What are the next, say, 3 to 6 months, Q4 2025 and Q1 2026 looking like? What are the next major checkpoints that could confirm or maybe derail this narrative?
Well, the immediate calendar is packed with critical dates. We're looking at the Q4 2025 earnings release, which is projected for January 7, 2026.
Okay, early January.
This will be the first chance for management to prove that the Q3 beat was sustainable, not just a one-off anomaly.
Crucial follow-up quarter then, and shortly after that.
Around January 16, 2026, we get the updated 13F institutional filings.
Ah, the 13Fs.
For the listener, these filings show us exactly which large funds bought into the stock after that massive Q3 beat. This is crucial data. It will either validate or potentially undermine the institutional confidence story we just discussed.
Right. See who bought the news.
Exactly. And don't forget the external catalysts. The institutional portfolio rebalancing for ETFs on November 27, 2025 could significantly amplify price movement.
Especially given that high beta.
Precisely. That 3.51 beta means passive flows, index rebalancing could push the price one way or the other, regardless of specific company news at that moment.
Okay. Finally, let's touch on the speculative catalysts, the rumors, the potential events that could drive a valuation re-rate beyond just steady execution. What's out there?
Well, given their leadership position in quantum, there are persistent rumors of potential major quantum computing customer press releases. Think big names.
Like a massive tech or cloud company partnership.
Yes, someone needing secure, U.S.-based quantum fabrication. That would be an enormous headline catalyst, obviously.
Definitely.
And given their trusted status, we see persistent chatter about direct inclusion in new targeted U.S. government chip incentive announcements. Perhaps tied directly to specialized defense or aerospace programs.
This is where that geopolitical advantage could really pay off again. Market chatter also suggests maybe accelerated aerospace defense program budgets could lead to front-loading revenues from existing government contracts.
It's possible. Leveraging that trusted foundry status for immediate cash infusion, that's certainly something analysts are watching.
Interesting.
And looking even longer term, the sources highlight that strategic M&A activity remains a genuine possibility. SKYT is a strategic asset within the U.S. semiconductor supply chain, a rare domestic specialty fab.
So a potential target.
Or a partner. A joint venture acquisition or partnership by a much larger defense contractor or tech conglomerate could unlock massive value for existing shareholders. It's on the table longer term.
Okay, so to try and synthesize all this for you, the listener, The investment thesis here seems to be that SkyWater technology presents a high growth but also high volatility opportunity. This turnaround story feels validated by those surging institutional flows we talked about. And it's clearly being driven by proven operational excellence, particularly in that explosive quantum sector, and the successful, quick integration of the new Texas facility.
Ultimately, though, while the Q3 report was a resounding victory, a real turning point, the long-term trajectory hinges entirely on continued execution. They must successfully integrate their influx of new customers, hit those timelines for advanced packaging down in Florida, and, perhaps most importantly, capitalize on the powerful geopolitical tailwinds that clearly favor U.S. specialty fabs in critical national supply chains.